Options involve risk and are not suitable for all investors. Options investors may lose the entire amount of their investment in a relatively short period of time.
Hello, today we're going to talk about common option trading mistakes that beginning option traders make. First of all, before we get too far, let's talk a little bit about what an option is. An option in general is a contract, and it gives the owner the right to buy or sell an asset at a fixed price for a specific period of time. It then obligates the seller of the contract to take the opposite side if and when the right embedded in the option contract is exercised by the owner. Bottom line is, the buyers of contracts, they pay cash, and for that cash, they get a right. The seller of the contract receives the cash, and for receiving that cash, they take on an obligation. All right, the first most common mistake that we're going to look at is buying out-of-the-money option contracts as their first trade. Out-of-the-money option contracts are very compelling to beginning option traders because they're cheap. But they're cheap for a reason. So we have to talk a little bit about that reason to understand why we are making that mistake. Now, before we get too far though, let's define in, at, and out of the money option contracts. On our graphic, we actually see the y-axis is the stock price. And our stock price here is going from 50 all the way up to 70. The x-axis is the strike price of our option contract. And today we're talking about a call option that allows you to call stock away. Our strike price in this instance is a 60 strike call option. So if the stock is at 60 and the strike is 60, that's considered an at-the-money option contract. It's fairly intuitive. As the stock price starts going up, guess what happens to the 60 strike call? It becomes in the money. And if the stock starts going down, guess what happens to the call? It becomes out of the money. Now let's look at an actual example. We have XYZ, which is a fake stock. It's trading at $60 a share. Our forecast is that we are bullish on the marketplace, so we're going to buy an option contract. We think the stock market is going to go up. We see our XYZ 30-day 65 strike call option is trading for $1. Now that's a very inexpensive relative to buying the stock. If it's trading for $1, that means that our total cost is $100 plus commission to buy this option contract. Now, our max risk will be that $1 if we only buy one option contract, or $100. Our max profit, it's unlimited on the upside. If the stock went to infinity, we would get infinity, highly unlikely, but if it did, we'd have that type of upside. Our break even now has changed quite a bit though. Our break even is our strike price plus the premium that we paid for the option contract, or $66 here in our example. Now let's look at a graphic of this actual trade and compare the profit and loss graph of the option contract to what the stock profit and loss graph is. We see here on the blue line, we see the stock is trading at 60. So where we cross the x-axis on our graph is going to be our break-even point. But with the option contract, we're actually going to the strike price plus what we paid for it. So our break-even is $66 here. And so here's the difference about just buying the stock outright relative to buying that option contract. If you buy that option contract, you're saying you expect the stock to move, in this instance, 10% before the expiration of that option contract. And we're only talking about 30 days here. So yes, that option contract was cheap, but realize if the stock only goes half the distance, it's at $60 and it goes up to 63 and it doesn't make it by that expiration date, it's possible to be correct on your forecast and actually lose your entire investment on the option contract. So how can you trade smarter? Let's not buy that contract. Let's look at selling the option contract. So the next example that we're going to look at here is actually selling a covered call on a stock that we own. So let's pretend that we own 100 shares of that stock. In other words, instead of just buying the call option at a 65 strike, we own 100 shares of the stock at 60. We then go out and look at this option contract that's trading with a 65 strike for $1, and we decide we're going to sell that, receive the cash, and take on an obligation to sell the stock if it goes higher. So, our example, We're long 100 shares. We're bullish on the stock. We think the stock could go up to 65. We wouldn't mind selling it if it made it all the way there. XYZ 30-day 65 strike call is trading for $1. We sell that. Our max risk is still substantial in that we own the stock. So we still have a lot of downside risk of owning the stock. But the option contract actually increases our profitability if the stock goes up to 65. So our max profit is only going to be 6. We have an opportunity loss if the market continues on up. Our break even here, we've actually lowered it from where the stock was at. It's 60 minus the premium received, or 59. And if we look at the graphic here, we have the actual stock price on the x-axis. We have the profit and loss on the y-axis. And we notice that we lowered our break even. Instead of making the break even higher by buying the call outright, we've now lowered the break even down to 59, which is the price of the stock minus the premium received. So when you're thinking about buying option contracts, you got to realize that they are priced much differently than buying stocks. So as opposed to learning by buying options, sometimes it's better to learn by selling options. So the strategy that I suggest for beginning option traders to start with, covered call writing. Well, that's it for today. I look forward to your questions and comments. In the meantime, may all the options you bought finish in the money and all the ones you sold finish out.